Indian financial markets are navigating a complex interplay of domestic liquidity, external funding flows, and currency dynamics that are beginning to show structural divergence across South Asia. The Indian government bonds sold off modestly after a recent auction saw tepid demand. It lifted yields as investors reduced exposure amid year-end risk aversion and concerns about heavy future supply. At the same time, India's external account is under stress from persistent dollar demand. The rupee has weakened to multi-year lows as importer demand for dollars outstrips exporter receipts and foreign portfolio flows remain subdued. Persistent outflows from equities and bonds have required state-linked interventions, and the Reserve Bank of India has at times tolerated a weaker currency to preserve dollar reserves while tamping down volatility. This has created an unusual situation. Local investors and corporations in India sometimes prefer accumulating rupees for domestic spending or hedging import exposure rather than holding dollars, even as external pressures mount. This reflects both confidence in India's long-term fundamentals and a reluctance to export scarce dollars at current rates. Contrast this with Pakistan, where dollar scarcity has more accurate and acute consequences. Despite some build-up in foreign reserves supported by the IMF and World Bank inflows, many importers reportedly struggle to secure dollars for basic needs, including oil and essential goods. Reports suggest businesses often pay premiums above official rates. Banks and exchange companies are unable to meet demand fully, highlighting a tight supply of greenbacks that constrains trade and fuels exchange rate volatility. India's pressures are therefore rooted largely in capital flows and debt supply dynamics, while Pakistan's pain is tied to a fundamental shortage of foreign exchange for basic imports.